Good morning, everybody. It's Thursday,
Hello.
10 a.m. How are you, Stacy?
I am good. I'm good. I apologize. I'm on a epic road trip, and there was no way to avoid being in the car during the live right. So bear with me, but happy to be here on this beautiful Thursday morning.
Gotcha. Yeah, we have an amazing show lined up here for Real Estate Now, our weekly podcast, video live chat here. We have Matthew Gardner with Windermere Mortgage Services. He's the chief economist, or excuse me, Windermere, not Mortgage Services, Windermere. He's the chief economist there, and one of my favorite voices to listen to during economic times, good and bad. Super calm, super direct as far as what the numbers are really telling us. But before we jump into Matthew and bring him in, I wanted to talk again about our viewership and our weekly give back. Stacy, you want to take that?
Yes. So last week we had a wonderful show about investing, and I really urge you guys to watch it. Amazing information. So super appreciate our guests last week. And we had 178 views, so we will be donating $170 to our local food bank.
Awesome. Another donation here on our weekly give back. And one other thing that we do at the top of the show is we take a look at what mortgage rates are doing. And again, another week of just steady Eddie mortgage rates. The Fed's calming hand has really settled the mortgage-backed securities market and created stability to keep those interest rates super low. And all the indicators say that the rates are not going up anytime soon. So if you still haven't taken advantage of the interest rates, either through a refinance or you're looking to take advantage of the interest rates and buy that house at the most affordable rate environment we've had in decades now, definitely it's a great time to continue down that path and jump into home ownership. So super exciting times for us. Going into the summer months, now that we're getting the sunshine out, we can jump on and get those mortgages done in a quick and timely fashion. So I don't want to belabor it any longer. There's one question that Stacy and I get asked all the time. Those folks out there that are watching the show that we interact with every day, our home buyers, our home sellers, our real estate agents, they're all asking, like, is now a good time? I'm hearing this information over here, I'm hearing that information over there. And so we just wanted to bring an expert, and our expert here today is Matthew Gardner. Welcome, Matthew.
Good morning to you, Keith. Good morning, Stacy.
Good morning. So I wanted to jump into it. Matthew, you've been doing statistical economic analysis for the last 20, 30 years now?
Good Lord, am I that old? Yeah, it's not quite 30. I think it's like 26, 27. It's been a while.
Gotcha. So you are chief economist with Windermere. You've got your pulse on not only what's happening in the real estate market, but what's happening in our nation and nations across the oceans. So I wanted to, I preface this discussion today about to buy or not to buy, to quote Shakespeare. That is right. So what can we talk to our real estate partners, our buyers and sellers, like right now, today, what kind of market are we seeing?
And that actually is a great question. And I know you're being asked it a lot, and so am I, not only from all our brokers, but certainly from their clients as well. I think there are a couple of things you've got to look at here. Obviously, you have to talk about, a lot of people talk about a correction. You kind of got to define the term correction. And a lot of that's driven by the term recession. There's a lot of people out there, quite accurately, are saying, are we going to be in a recession? Are we in one already? And we are. Now, when you think about recessions, we automatically revert back to 2007. However, we are in a very, very different place now than we were then. So I think those people are out there thinking, the economy is falling apart. You're going to see the housing market fall apart. That really has not been the case at all. The housing market has thus far been remarkably resilient. And I think it's going to continue that way. We have a lot of pent-up demand, limited supply. You mentioned mortgage rates. believe it or not, for I think there was 2 days, week before last, rates on a 30-year broke below 3%. So
Yep.
historically low. We've never seen it lower. Some are saying we could actually get down into the high twos, and a lot of demographically driven demand. Combine all those things together. It's a market which I think is going to be leading us out of this recession. It's going to be a leading indicator rather than a lagging one.
That is great to hear, and I think there's a newfound value in your house now, especially with COVID-19, and we're 3.5 months into stay at home. Well, we were briefly talking before we went live about. I think you said people are living in their houses now and kind of picking at it and seeing maybe they're ready for a bigger house or getting out of an apartment.
Yeah, and I think it's quite likely we will see a kind of a COVID-induced movement in the real estate market. Now, it's going to be fascinating to see how that all plays out. And there's several reasons, one of which obviously you mentioned, and that is the fact that what do we do when we are around anything for too long? We start kind of picking at it. Now, I don't really like this, I don't really like that. So I think it's quite likely some people that would not normally be thinking about moving this year or maybe next year, they might say, you know what, this house just isn't right for me. They're finding the flaws in it. But more importantly, I think also there are going to be people who are going to be either permanently or at least part-time working from their homes going forward. If that's the case, a lot of people, I'm sure, like myself, I've been working from my dining room table now for the last 3.5 months. It's getting boring, but I think a lot of people also might find themselves saying, I have to move because I now need a dedicated space for a home office again, which again, we haven't seen that. We've seen a move away from that concept for the last couple of decades. It would not surprise me ultimately, therefore, if we see more people make that choice to move, not because you'd expect to see them, but it's going to be a COVID-induced move.
Interesting. Well, that'll be a new buzzword.
Yeah, and I think to add to that, like I'm curious how many people are going to move out of maybe more expensive metro areas to the outskirts if they're working from home. There's not the reason to be so close to a center if you're not needing to drive into it. So, I mean, we have friends moving to Montana they can work. They're going to keep their jobs. I'm working away from my home office for the next 5 weeks and not skipping a beat. So I think it's going to be really interesting to see the housing market and where it does go with COVID.
Right.
So one thing that I've been seeing a lot, and I want to jump into two very specific numbers. We have a lot of headlines that are out there that housing sales are off by 25%, and I think what happens is a lot of people equate that to, oh, my house just lost 20% of its value. But then they go look at the market and they see, oh, price appreciation, though it's in no way, shape, or form quick and heavy and big, it's very moderate. They're like, well, why are sales off but houses are going up? Could you put some explanation behind that for us?
Yeah, of course. And it's really rather simple. Go back to March. Obviously, the government, in essence, shut down 40% of the nation's businesses. We had the shelter in place going on. So, in essence, a lot of people could not sell in March. And because of that, viewings basically fell off a cliff. And that was the case through mid-April, before they started to improve again. Now, different markets have different lockdown policies, and obviously that will affect markets in a different manner. So seeing a contraction in sales, totally not surprising. And it literally was COVID-induced. People weren't looking, because for a lot of brokers, and certainly even now in California, where you cannot have face-to-face meetings, even in many parts of the country also, you can't have open houses. A lot of people took their houses off the market or did not list them. Therefore, we saw a massive contraction in the number of transactions. But I would argue the bottom of the market would likely be the main number which just came out. Now, with prices, as you mentioned, existing home sale prices did drop by a whopping 0.7% month over month, but they are still up by almost 2.5% year over year. new home median price is up 5% month over month, just shy of 2% year over year. So I think this is a case of a supply issue slowing down sales rather than a pricing issue. And I do expect prices to start moving up, but as you said, modestly as we go forward through the second half of the year. There are some people out there, Zillow, are saying that they expect to see a sub 2% price drop between now and Christmas before picking up again. CoreLogic are seeing, I believe, a 1.3% price drop between now and next April. I'm positive. My view is we'll see year-over-year prices up in America by about 1.7% in 2020 over 2019. Very modest, certainly the lowest rate of growth since we came out of the housing bubble in 2012, but not going backwards.
So you touched on the Great Recession and
those were national numbers, right?
Yeah.
Gotcha. Coming out of the Great Recession in 2012, when we started going back in an upward shape, tell me, we're not going to see a major meltdown like we did in 2008, because there's a lot. I'm part of a couple investor groups, Seattle Investors Club, Addicted to ROI, and there's investors on the sidelines that are saying, oh, something major is going to happen and there's going to be a huge price correction. Tell us your thoughts on that.
Yeah, and in any situation that we have similar to this one, although this is obviously very unique, anytime the economy starts slowing down or going backwards, the presumption is that that's going to hit housing prices, and it is just not. And quite frankly, here's the biggest reason why. And if you go back to 2007, 2008, what do we see then? A massive oversupply of housing. That is not the case today. We are significantly undersupplied. Listings today in America are at generational lows. So no supply. Builders are not building. We might talk about that momentarily. But the biggest difference also is the fact that the lessons learned from 2007. We went from being remarkably unqualified to buy our homes to become remarkably overqualified. I mean, the average down payment last year was 16%. It's a very, very different environment than we were when we had the liar loans and no doc and low doc, and my favorite, the ninja loans, no income, no job or assets. And so the way we are today, one is that we're absolutely qualified. Secondly, forbearance. Forbearance, the program FHFA implemented back in March. And it was a very smart move on their behalf, I would say. And that is because they're saying, you know what, there are some homeowners that might be laid off, might be furloughed, and it's unfair to just see them losing their homes. So a lot of people, 5 million people, 4.6 million, have entered forbearance. And that means that in essence, they can delay making their mortgage payment for a period of time. That means we're not going to see a flood of delinquencies. And so it really comes down to supply and demand. We are not oversupplied at all. We're undersupplied. A lot of people through this whole crisis are still working. And so this is hitting the apartment market far harder than the ownership market. And over a quarter of us have over 50% equity in our homes. We are not in 2008. It doesn't concern me. And if there are people sat on the sidelines, I would say one thing, and that is get a good book, because you're going to be hanging out for a very long time.
Fair enough. That was a really powerful slide that you shared. I think it was 2 or 3 weeks ago on your June 5th episode of Mondays with Matthew. The equity positions in houses was quite substantial and fundamentally different than 2007 and 8. So it was awesome to see that. Don't quote me on this, but it was roughly 80% of all households had over, I think, less than 70% leverage on their house. So they had a 30% equity position.
Yeah, it depends which way you cut it. So you can look at the market overall, and about 1 in 4 has more than 50, but a lot of us have a significant equity position. But I believe on that particular slide and that video I did, that was actually looking at homes that were in the forbearance program. So if you're in the forbearance program, 80% of households in that program have more than 20% equity. Only 10% have less than 10. So if we are going to see any fallout, it's without a doubt going to come from those people who are in a very low equity position. It's a lot easier to walk away. So again, if you talk about it, when we come out of forbearance, are people just going to walk away from their homes as they did in 2009, 10, 11? Don't see it happening. And it also allows their lenders, if they've got more than 20% equity, it's a lot easier to start repositioning that loan, refinancing it. There's all kinds of things you can do to get people back to recoup the payments that they had deferred.
Very true. Very true. So my next question is a supply and demand question. So you were talking fundamentals of supply and demand, and one of the reasons why, fast forward from the meltdown, that we got into such a supply pinch is because builders didn't build for the better part of a decade, right? And you see a very steep decline in the new housing starts here in the last few months. Is this just setting us up to compound the issue of supply and demand on a long-term basis?
Yeah, and it really is. So here's this fascinating situation. We saw a massive run-up in home ownership rates and owner-occupied housing units really starting back in the mid-1990s because of President Clinton. And that was then continued by President Bush. And at that time, builders were building a lot, sticks and bricks flying up everywhere. The bubble burst. We saw a massive drop in new home starts. However, as we've recovered for the last, you could argue, 8 years, we haven't seen a significant increase in the number of homes being built. As you mentioned, homes under construction, 503,000 in May. It's the worst since 2017. The biggest problem we have as a housing market is you see above average price growth when you limit supply. Builders should be building more, but they are not, in essence, for 4 reasons. And 1, land costs, astronomical. 2, labor costs are going up. A lot of people got out of construction in 2009. They got into the oil industry. They've not come back. There's 370,000 job openings in residential construction today in America. So that pushes up labor costs, material costs. They continue to rise. Thank you, tariffs with China. So you've got steel, you've got aluminum, copper prices are rising. Even lumber prices, because we have actually a trade war with our friends in Canada. So Canadian softwood lumber prices have gone up. And finally, regulatory fees. 25 cents in every dollar it costs to build a home are regulatory fees. So if you combine all those costs, and here's a hypothetical. So a builder wants to build in whatever market it may be. They know their land costs, labor, materials, regulatory fees, put some profit on, and that will then spit out a number they have to sell the house for it to make sense. But what if that number is, I don't know, $1 million? Okay. But if the market price acceptance point is 500,000, are they going to build? No, they won't. And where we are losing the most is in the entry level and first time move up buyer market. And that's who we should be building to. Millennials are going to be a massive force in housing for the next decade. But we're building to the luxury end, what we're building at all, because that's what you have to do to make some money. So because of that, undersupplied, if you're undersupplied but creating households that want to buy, that forces them to look at the existing inventory, resell homes, and that has therefore pushed resale prices up, annualized at a well above average rate. We need to build more, simple as that.
Where's the best relief for a builder right now? Is it fixing the trade war situation? Is it regulatory compliance? Is it all of the above?
I would say it's a combination of things. I think let's go through the list. Land. If you are in an area which has not only geographic constraints, but geopolitical constraints to growth, that's the problem. Where are those markets?
Seattle? Or are you talking about Seattle and
Washington, Oregon as well, California. So, and in essence, it's on both seaboards. Because you have that situation, what goes on is you limit supply artificially, that pushes up land prices. That's going to be a problem certainly here. You mentioned Seattle. Yeah, 70% of the city of Seattle is zoned single family. That might have made sense back in the 50s. It does make no sense today. That is a problem. Labor, you can't force people to come back. We need to get people to go to vocational school. Maybe they will start again, possibly. But right now, a shortage there can't really fix that. Material costs, again, I think trade wars, if we could solve it, that would be nice. Not a panacea. And quite frankly, I just don't see that changing, at least through the current administration. So what we can do ultimately is look at the government. We need to figure out how governments can actually help, and by understanding the tax revenue streams that will grow if you add more housing. But right now they're in a situation, they're starving for money. It's very, very unlikely you're going to see those costs or any city or any jurisdiction agree to reduce them.
Yeah, it's an interesting financial conundrum. I'll tell you this: I'm building a treehouse for my kids, and I was surprised by the cost of lumber.
Yep.
I was like, "Wow, this is going to get expensive quick."
And you're absolutely right. We actually have seen, quite frankly, we've actually seen lumber prices, believe it or not, actually drop the last year. Until a couple of months ago, they've started to rise again. So yeah, and bottom line is, it is expensive to build a treehouse, and it's expensive to build a home.
Yeah. So we're getting close to an hour, and I wanted to wrap up the obligatory question that every single economist is: are we in a V-shape recovery system? Are we going to be U-shape? Are we going to swoosh it out like the Nike symbol? So what do you think we're going to do here, Matthew?
And you're absolutely right. A question we are being asked with monotonous regularity. As with being any good economist, will actually not give you a direct answer. We are really good at doing that. So here's the biggest problem we've got, and it really is, the question is going to be, when is the country going to reopen? Do I expect the second half of the year to be better than the first? I have no doubt that that will be the case. However, we are starting to reopen the country, and unfortunately, a lot of states are not behaving. They're going out partying like it's 1999 again. They're not wearing their masks. They're not doing what they should do. So my concern is we could see a slowdown. But in essence, what I see, hopefully, is that there's no one answer. And it's going to be very much dependent upon which economic sector you're looking at. Talk about a V shape. Real estate, so residential real estate, absolutely, a V. Technology, yes, a V. Manufacturing, a V. Now the U, where you drop down, hang down for quite a while before coming up again. That I'd say the tourism industry, certainly hotels, aviation. I'd also add retail, healthcare, and probably automobiles as well. I think they will take longer to emerge. Then you've got the dreaded L. L is when you go down, you don't come back up. I'm really looking at cruise lines and theme parks as being groups who are going to have a big problem for a long time. But in aggregate, I think we are likely going to be more of that Nike swoosh, massive downside to start with, gradual improvement. And I expect the unemployment rate is going to come in about 10% by the end of the year. We will not be down at 3.5% anytime soon. If we end 2021 at 6%, I think we'll be doing pretty well. So I think a lot of the jobs that were lost are not going to come back, but they are very focused in certain industries. It's certainly not across the board.
We talked briefly about the commercial world of real estate, and that is going to be more long term. But is there a second wave of unemployment that would be coming down the pipe if the small and medium sized businesses that have been kind of walking around on a crutch of the payroll protection program, what kind of impact is that going to have long?
Yeah, and I think it's we have to look at what sectors suffered the worst when the recession hit. Two sectors: leisure and hospitality, therefore hotels, bars, restaurants, and retail. Retail Xing out online. Amazon is still killing it. And grocery stores still doing remarkably well, because apparently we need to buy a year's worth of toilet paper. So they've been doing well. So a lot of people got laid off there, and certainly those are people that are staying unemployed. They are taking that extra $600 a week. And quite frankly, in Washington State, if they were making less than $37 an hour, they're making more on unemployment than they were working. That's going to keep the unemployment rate a bit higher. But I think we need to look at the makeup of it. across the country, unemployment in hotels, in the hotel industry right now, 45%. Bars and restaurants, 32%. If you're in the movie business, that's actually 31.5% unemployment. Even laundry services, the unemployment rate there, 34.5%, because we're not going out, not at work, we're doing our own laundry again. So but that doesn't apply across other sectors. Financial activities, doing well. Real estate, residential, doing well, even though they are obviously independent contractors. So I don't see a second wave, but I think that these other industries are hurting far more. That's 2 jobs in 5 in America, massive component. And I think what will be interesting to see is if this extra $600 goes away, what will happen then? And are they going to go back to work, or are they going to have a job? Imagine you both going to your favorite restaurants. When you go back there again, hopefully you will, you're going to find one thing: fewer tables, social spacing. So as you see fewer tables, what does that mean? That means the requirement for less servers, the requirement for less cooks. And so I think that what will be, I'll be watching very closely is how many of those jobs will come back. In hotels, front of house staff likely go away. We're going to revert or change to an all online, not just registration, but checking in as well. So I think some jobs just are not going to come back. And what will those people do? So I don't expect a second wave, but the unemployment rate in aggregate will remain elevated until they find out what their new vocation is going to be.
Wow, that's crazy.
This might be too.
Go for it, Stacey.
Sorry, I just had a question about if you could give them insight onto if we stay on travel, like what is your forecast for places like Hawaii and Las Vegas and places that depend on the travel industry?
Yeah, let's travel. Las Vegas specifically, there are 300,000 people working casinos, and that's why they are screaming to try and get things reopened. I was actually on another call with our offices down in Las Vegas. They showed me a photograph of the strip. There was no one on the strip. It's just surreal. So I think, again, it's going to depend on when are they allowed to reopen and what is that going to look like. So again, I would suggest when you talk about even ownership housing and how that's is going to do well, it's going to be leading us out of this recession. It is going to be definitely dependent upon where you are. Do I see Las Vegas lagging? Sure. But there's also other markets. Myrtle Beach, South Carolina is another market, heavily tourist dependent. That might lag a little bit as well. So all improvement's not going to be equal across the country. Areas where tourism industry is a significant component of employment, yeah, I think it will take a bit longer until we feel comfortable again, not only going out socially, but also going on vacations to hotels, but also, more importantly, when a business conference is going to start again. Unlikely this year. I get about 75 forecasts out of state a year, and all my bookings, once COVID hit, now through next January, they all went away. Because no one's sure, one, when you are allowed to do it again, but secondly, whether people are actually going to want to go and be in a conference and not Zoom it.
That's a good question. I mean, that's a consumer. We should create a new index, Matthew.
Another one.
So, where's the COVID confidence index?
Yeah, and it does come into those open table and various other very high frequency data sets, which I'm looking at now to see when we can get open. We talked about open table and looking at their numbers, which are daily, which is fun. But what's interesting there is that I tracked what happened when Phoenix reopened. A whole bunch of people went to their restaurants. But what happened after that? They all came down with COVID-19. So you actually saw restaurant reservations plummet about 3 weeks after that. So, I mean, I think we are social creatures. We want to go out, but we've just got to be smart about it. And some markets, shall we say, are smarter than others.
Gotcha. Well, in wrapping up, speaking of smart, I want people to be able to follow you and see your information, because you bring some really relevant topics to light, and you bring a non-inflammatory delivery to this, because I think if on any news channel, they want you to get all hot and bothered by what's going on. And I love your calm through the storm. So how do people find you, Matthew?
Sure. You can follow me, obviously, all social media. I'm on Facebook under Windermere Economics or Matthew Gardner, Twitter, Seattle Econ, LinkedIn. I think it's Matthew Gardner there as well. I've got a YouTube channel that you'll find fairly easily that has all my videos on it. And alternatively, it's reach out. I'd like, if you have a question, send me an email, m.gardner@windermere.com. And I would be delighted, if I'm able to try and answer it. I think it's very important because not just for brokers, but consumers. For 98% of us, buying a home is the most expensive thing we will ever buy. We want to do the right thing. And when there's uncertainty, what do? We get frozen. We end up just getting stuck in place. And so I'm there to act as hopefully a conduit. But believe me, if I think the market's going to be horrendous, I will be screaming it from the rooftops. So it's good, bad, or indifferent. I'm just going to call it the way I see it.
Right. Well, I appreciate that. And Matthew, thank you so much for taking time. I agree with Joseph here with some great stuff that you brought to our show here today. And enjoy the summer. We're summer months now. It's beautiful. Get outside with your mask if you can. And thank you so much for your time.
Oh, you're very welcome. Thanks so much.
Thank you, Matthew. We appreciate it.
You're welcome, Stacey. Good seeing you.
Well, Stacey, that wraps it up. Join us next week and enjoy your road trip. Travel safe.
Yes. Thank you. Thank you. We'll talk to you soon.
Right on. Take care. We'll see you next Thursday, everybody.